So we're going to talk a bit about investing in private mortgages. So this is more of a hands-off, passive investment vehicle, right? Essentially, you become the bank, right? So you're familiar with the typical homeowner who has a mortgage from the bank. They're paying their mortgage each month. If they happen to not pay their mortgage for a while, the bank can then take the house and sell it, right? As an investor, you can actually lend money to a homeowner, have it registered against the title of that homeowner by a real estate lawyer, and have that homeowner pay you each month. And that is essentially a private mortgage. Now, with private mortgages, the interest rate is much higher than what you'd find from a bank. Good mortgage rate these days, a 5-year fixed might be 2.5%, right? Private first mortgage is around 7% because it's an individual who's looking to make a return on their money, right? Typically, though, the investor is going to want to invest in second mortgage rather than a first mortgage, because a second mortgage you can make 12% interest rather than the 7, right? So the way that works is, let's say that you have an $800,000 house, right? And the homeowner owes $400,000 on the first mortgage, but he wants to renovate his house, build a basement apartment, so on and so forth. He doesn't want to break his first mortgage and pay a huge penalty. So he's going to get a second mortgage for maybe $100,000, right? He would approach a mortgage broker like myself. I would find the money from a private investor. We register the $100,000 against the house. He pays each month. It basically works out to be $1,000, right? Because he's paying at 12% a year, right? So you would receive direct deposit $1,000 each month. Now, me personally, what I like to do is prepaid. So if you're loaning $100,000 and we know that it's 12% that you're getting on that return, we'll deduct the $12,000 up front. So the homeowner is really only getting $88,000, right? And at the end of the 1-year term, you get your whole $100,000 back. You've already gotten your return initially. You guys follow what I mean? We'll go through the slides, but that's the gist of it. So the goal that you want to do, you want to secure your capital, secure your return on your investment, and secure your exit. Because if you're not exiting with your money, it's no good to just have it tied up there, right? Secure your capital. Your investment is secured against the real estate, right? Again, if the person doesn't make your payments, then you can take the person's house and sell it, right? It's underwritten by a mortgage broker and administered by a lawyer. We get a professional appraiser to go out and ascertain the actual market value of that home before we issue any money on it. We ensure that the loan to value, so the amount of the loan versus the value of the home, does not exceed 80%, right? We just don't want anybody's money at risk. Secure your return. The rate of return typically is 12%. So again, if you're loaning $100,000, $1,000 per month. We often arrange for the entire term to be prepaid. Again, so that way, there are no monthly payments for him to make. And if there are no monthly payments, he can't default. Right? And the other benefit is you know exactly how much money you're going to get. Your rate of return doesn't fluctuate. So if you were to put your money into a mutual fund or the stocks, that stuff goes up and down all the time. You don't really know what your return is going to be, right? Here it's already predetermined. Secure your exit. So each one of these private mortgages has a fixed term. Usually it's 1 year. At the end of the term, the mortgage has to be paid back. Typically, that homeowner is going to refinance either his first mortgage and pay out the first and the second, or he'll just refinance the second with a new mortgage to pay you out, right? Or they could sell. But either way, after the first year, it's got to be repaid. During that year, if the homeowner wants to sell, remember this mortgage is tied to his property. So in order for him to sell, he's got to pay you back your money. Same with refinance. If they want to refinance their home, your money would have to be paid back. The exit strategy, as a mortgage professional, I typically discuss that with the borrower ahead of time so we know exactly what the exit strategy is going to be. Are they going to be selling? Are they going to be refinancing the first or the second? We know how your money is going to come back to you.
Just want to make sure I'm understanding this. So this is like the lowest ROI you're going to make when you look at investing.
some of the other,
property,
yeah,
right?
yeah.
So, so you can basically, the money you're making is just the interest. So if it's 12% on your, so you said $1,000 a month, essentially you're making $12,000. So it's low, but you're still making money.
Still making, and it's totally unlike some of the other things we're having to deal with tenants and that sort of stuff. It's totally passive income, right? There's no learning curve here where you have to potentially go to a landlord tenant board and battle some wayward tenant or anything like that. It's just basically you park your money like you would any other investment, and there are ways to make it RRSP eligible. There are ways to redirect your own RRSPs into this type of investment vehicle. So it's a passive investment.
So if I went to my bank and said so I have a mortgage, right? I have a house. So that means I can go to my bank and say I want to take out a second mortgage to make money. Like, is that how it works?
You wouldn't want to do that. Well, first off, banks don't offer second mortgages.
Okay, so
You could take out a HELOC, a home equity line of credit, right?
okay.
And so you make a spread. So the HELOC, usually they're around 4% interest rate. So if you're making 12, you're really netting 8, right?
Right.
So yeah, a lot of people do that though. They use the equity in their home.
Okay.
Maybe they'll use a HELOC, or maybe they'll just refinance, right? Get a new mortgage at the end of their 5-year term. They'll refinance at a lower interest rate than they had already. So they're borrowing 2.5%, and they'll still be making 12. You know what I mean?